All right, what's going on, everyone? Welcome back to Investing Sucks. As always, my name is Eric, and thank you for tuning in. So, today we're going to be taking a look at a company called ACT. Now, I'm just going to call them ACT because their name is French, and I can't really pronounce French words that well. So, apologies to all my French viewers out there. But this is the company here. They're currently the 16th largest company on the TSX in terms of market cap. Of course, we have Shopify up here at number one, followed by RBC. But currently, they are the 16th largest company. So they're a pretty big company, about $42 billion in market cap. And what we're going to do today is just take a look at some trends that are playing out in the industry they're currently in. So they're in the convenience store slash gas station industry. And we're going to take a look at how this company's performed in the past and then attempt to value them using the discounted cash flow model like we always do for profitable companies on this channel. I've had a few subscribers mention in the comment section they wanted to see a video done on this company. I think a lot of people look at this company, especially people who primarily invest in TSX stocks. So I think it's going to be worth taking a look at. It'll be an interesting study as well. So we'll do the DCF model. We'll see what type of a return we can earn if we buy the stock today at its current price and hold it for about 7 years. So the goal of this video is not to tell you guys directly whether or not you should buy or sell this company. That's a decision you've got to make. But what I try to do in these videos is really to just show you guys how to go about gathering data points and certain things you can look at with companies and then tie that into an actual valuation, because then you can realistically determine what type of a return can you expect given your assumptions and what you expect for the company and what type of trends are playing out in the industry. So we'll go into that now. Okay, so I'm sure many of you guys are aware of who this company is and what they do, but for those who aren't, basically they're just an operator of convenience stores and gas stations. So not exactly the most exciting of businesses, but this channel is called Investing Sucks for a reason. And they operate not just in Canada, but they are actually quite global, as we could see on this map here. They've got international licensees, which is this yellow part here. So these tend to be in, I guess, countries where they don't have that well-established operations. They will use a licensing model, and then their core network would be stores that they actually own. So the company itself owns. And I believe as of making this, they have about 15,000 stores worldwide, and about 1,900 of those are the licensed stores that you see in yellow. So those tend to be the ones in countries that I guess are a bit further away from the headquarters, but it does show that they do have some international exposure, and we'll get into why that's interesting later. So what you're looking at here is a summary of their revenue for their Q1 of the 2022 fiscal year for them. So their year end is April 30th, 2021, which means this is data as of the beginning of May into the end of July. And this can help us determine kind of how they earn their revenue. So like I said before, it's mainly convenience store sales, which would be merchandises here, and then what they've called road transportation fuel revenue. So that would essentially be their gas stations. And then it breaks it down into each region. So the US clearly makes up the majority of their revenue as it stands today. So for this quarter is about 9.4 billion total for the total road and transportation fuels revenue, with about 6.5 billion of that coming from the US. So that's their largest revenue source. So as the company stands today, a big chunk of their revenue is from the gas stations, most of that being in the US, but also other regions in Canada as well. So I think when a lot of potential investors in this company would look at it initially, they may kind of dismiss it because so much of the revenue does come from gas stations, which isn't really aligned with the trends that I think a lot of people want to see play out in the stock market these days, such as green energy specifically. That's kind of the overall sentiment, is that you should be investing in green energy as opposed to companies that operate gas stations or oil companies, because that's kind of a thing of the past. You should be focused on where the future is going. And that can lead to getting some potentially good deals in these companies that are still very solid companies, but are just being overlooked for a very surface level reason like that. So that's why I think this company does stand out to a lot of people. It is valued rather cheaply comparatively to other companies. And so as a prudent investor, what you'd want to do is ask yourself, is the sentiment overblown? And is this company being overlooked for whatever reason? So that's what we're going to try and answer here. Now, something else that's important to note about this company is that the way that their common shares are set up is a little bit different than your typical company. So they have, you may have noticed they have Class A stock and Class B stock. So you'd see that in the ticker symbol. I believe it'd be ATD-B versus ATD-A, denoting which one it is. So that's a little bit different, and you may be a little bit confused by that. But basically what the difference is Class A shares hold 10 votes, whereas Class B shares would only hold 1 vote. So the Class A shares are very much held by the four founders of the company. And as a result of that, they're a lot less liquid. So if you are someone who you're just looking to open up a stake in this business, then you should be looking to their Class B stock just because it's a lot more liquid. And it was a structure that was put in place by the founders who currently hold about 76.3% of the business. So what you kind of have to accept if you want to invest in this company is that it is primarily going to be a founder owned company, and you're just kind of along for the ride there. You won't really have much say in being able to vote on different issues that end up coming to the company. So what this article is basically saying here is that there's this part of the conversion rights of the shares that will say that once the youngest of the four founders, which is this guy here, once he reaches his 65th birthday, which happens in December of 2021, that all the Class B shares will convert into Class A shares. And if we go over here to this proxy circular that was released, it basically confirms what it says here. So it says each Class B share will automatically be converted into one fully paid non-assessable Class A share on the earlier of the following. And then the day all four of the co-founders have reached the age of 65, which happens in December of 2021. So that's actually happening quite soon for this. So this isn't really something that actually impacts the value of the business, just kind of who owns it and how much of the business they own. It's really in place there to ensure that the founders have protection in the case of a hostile takeover. So some outside company that wants to buy up their company, if they think it's valued really cheaply, can't just come in and scoop up all the shares, because if they own most of the shares, they're protected against that. So that's something that you do have to be aware of if you do want to invest in the company. But again, nothing really that impacts the actual value of the business itself. Okay, so now what I want to dive into is one of the most important trends that's occurring in the industry this company operates in. So as we know, they're a multinational company, and a lot of their revenue as it stands today is coming from gas station revenue. And obviously a big threat to that is going to be the future electrification of cars. Now, a lot of people disagree on the extent to which cars will be electric going into the future. People definitely have differing opinions on that. There are some people who can't really see a future of anything that isn't just electric cars and nothing else. There definitely will be some people who want to stick with gas-powered cars, but what the world's going to look like 10 years from now is anyone's guess. So as it stands today, this is a company that benefits from gasoline. And even if we assume 30 years in the future that they can completely transition out of gas stations and instead into EV charging stations, which is what you're seeing on the screen here, is what they're doing. They actually have a pilot project with this going on in Norway currently, where they're looking at EV charging stations, and they're currently gathering customer data on charging habits and seeing how this can be rolled out into other places like the US and Canada and all their other locations where they earn more money from. But the problem is it could lead to lower amounts of revenue in the future than as they currently have today. So this is a very real risk. In 30 years' time, they could lose a significant chunk of their business and potentially fail to recover for it, because I'm not an expert in this field, but one of the bigger reasons why people are moving to electric vehicles is because the charging cost for electric vehicles is generally lower than what it is to refuel a gasoline powered car. So if we were to assume in the future that the company could only generate, say, 50% of the revenue they're currently generation from their gas stations, as with if they had EV charging stations, just because the amount of revenue that they could earn from that is lower, that's a pretty big risk to the business. And that could mean 10 years out in the future, their revenue might not even be growing, or might not be that much higher than what it is today. And obviously you don't want to be invested in a company for the long term that has such a negative secular trend weighing down on it. Now, it's a good thing that they are doing this pilot project in Norway. It shows that they want to be on top of this trend and they are thinking about it. But it may be a situation where there's just not much they can do about it, because as we saw, a lot of their revenue comes from gasoline. And if people just don't need gasoline anymore because everyone has electric vehicles, then the business as a whole might be worth a lot less 20 years from now if they can't grow their revenue in other areas than it is today. Now, one way they could combat this is by expanding to other countries, because again, not an expert on this, but this is just, I feel this is pretty common knowledge. A lot of these other countries that this company operates in outside of the US and Canada just do not have existing infrastructure in place to support widespread electric vehicle use. And it would take them a very long time before that changes, because there's not many countries out there that are as rich as the US, for example, and can spend trillions of dollars on infrastructure. So that's one way that this company could grow into the future, is by expanding more into those markets that are still ways away from electrification and still very much rely on gas stations as infrastructure for powering their vehicles. Okay, so now let's move on and look at 7 years of historical financial data for this company, which I have here. So all these numbers are in millions of USD. So we can see over the last 7 years that their revenue's grown at about 4.1% per year. Now, this is skewed a little bit because they did have such a down year in 2021 specifically, but also a little bit in 2020. Their year end is April 30th. So there would have been a little bit of the lockdowns there that would have decreased this revenue. So 2019 is more of a representative year of what a normal course of operations could be, assuming you think that none of these trends that we see playing out in a post-lockdown world will continue into the future. But what was good to see is that their net income actually grew quite a lot, and it actually grew year over year, despite the fact that their revenue went down so much. It went down 15.5%, but their net income was up. So that shows that they do a very good job managing their costs. They know what they're doing. And I guess the way they have their contract set up is they don't incur too many costs in the case that there's a sudden decrease in demand, which is what we saw here. And then cash flow from operations has grown at a pretty similar pace to net income. So all these are really good signs. And then if we move down here, so this is the metric that I like to look at. It's free cash flow to equity. It's calculated by basically just summing these numbers here. So the traditional definition of free cash flow is just cash flow from operations minus your capital expenditures. I also like to include debt in this part, because debt is obviously very important. If a company is paying down debt, that's money that isn't available to the equity holders of the business. It's money that goes to the debt holders. So it's important to take that into consideration. And then I look at, as a way of projecting what their free cash flow will be going into the future, I usually just take a percentage of revenue here. So that's what this number is designed to capture. I look at it on two ways: if we exclude the impacts of the debt, and if we include it. So if we just use the traditional free cash flow to equity method. And now their shares outstanding have been decreasing a little bit, about 0.67% a year. They are actively buying back shares. So that's one way they're deploying their cash. Obviously, another big way they're deploying their cash is by acquiring new businesses and expanding their locations, because that's a big source of growth for this company. And that's probably what they're going to have to continue going forward in order to grow and continue to meet investor expectations there, because, like I said before, they're going to need to expand into other markets. And they've typically done that not by issuing shares, but by financing those with debt and just existing cash that their business generates. So that's a good sign. They do also pay a dividend here. And we can look at the dividend in two ways: as a percentage paid out of their free cash flow, if we just define it as free cash flow, as cash flow from operations minus your capital expenditures, or if you look at it in the more technical way, which is free cash flow to equity. But overall, they have been paying a very affordable dividend. Not a lot of their funds actually get paid out as a dividend. Most of it they're retaining in the business. So some people are more seeking passive income. This is not a company that you'd be looking for if you want, say, passive dividend income in retirement, because they don't pay out a lot of it. They're still very much looking to deploy their cash in investments or in things that will expand the business going forward. Okay, now what you're looking at here is my valuation model. So this is a spreadsheet that I created for all my subscribers to use completely free of charge. I'll leave it as a link to the description of this video. So if you want to go there and download this, you can do that, and you can use this for your own analysis. If you want to look at companies, it basically does all the calculations for you. So this is the free cash flow model. So I have a discounted cash flow model down here. But I prefer to kind of look at it on an IRR basis, which is what you see here. So I'll explain that more in a bit. But in the pink here, you enter your assumptions, basically. So I put these assumptions here. I want to do a 7-year analysis. The most recent year was 2021, and their revenue in that year, so this would be ending April 30th, 2021. The revenue that year was about $46 billion. Now, I'm assuming it's going to grow at 7% a year. So that obviously is higher than what we saw it had been historically. But the reason for that is because 2021 was a very down year for them, just due to the lockdowns and the reduced demand for gas stations, pretty much. So If we go back here to their financial statements, we saw in a normal state, they're almost doing $60 billion in revenue. So under that assumption, 7% annual revenue growth, that's pretty conservative overall because it doesn't really project them getting back to that level until 2025, which may be rather conservative. They could get back to that level in 2023 or maybe get close to it next year, you know? So I think overall it's a safe assumption to make. Now it does assume that in 2028, their revenue will be about $73 billion, which is quite high. But again, as we've seen in the past, this company is growing. They've been growing for quite a while. So I don't think it's an unreasonable assumption. And then I just took free cash flow to equity as a percentage of revenue. So this is what you get. This is why you invest in a business. This is the intrinsic value part of the business because it's the cash they generate that is available to you as an equity holder of this business. So if we go back here, usually I take a number that's somewhere in between these two numbers, which looks at the average of what it's been in the past. So this number here is going to fluctuate a lot more because that it includes the debt impact. So if they paid down a lot of debt like they did this year, they paid down $3.7 billion worth of debt. Rather, they actually issued that much debt versus here, they paid down a lot. And in 2021, they paid down 2.1 billion in debt. So that's why free cash flow to equity is lower here. But this one is a bit more normalized because it doesn't include that. So I usually take a number that's somewhere in the middle of here, but is a little more on the conservative side. So that's why I picked 3.5%. Now, current shares outstanding was this, and I just assumed they're going to be buying back shares at the exact same rate as they've been doing in the past, which is about 0.7%. Maybe it's a bit higher than that, but we could just leave that in as potential upside. And then the free cash flow yield in 2028, this is kind of like your terminal value in the DCF model. I just assumed it's going to be 5%, which basically means the multiple of their free cash flow to equity in 2028 is 20 times, which is about what it's been in the past. You can see here, it's averaged about 5.5. So maybe that's a little bit more of an aggressive assumption, but I think overall for the model, it works. Now I have to put their current share price. I converted it into US dollars just because all the other numbers are in USD. So as we can see here, their shares were about $48 as I'm making this video. And if we convert them at about what the exchange rate has been, we get 1.23 for the Canadian USD exchange rate. So USD share price of $39. And then if we continue, I've put a required rate of return. So this is for the DCF model here, 15%. So what we try to do in this channel is identify investments that have at least an assumed rate of return of 15%, because the TSX over long periods of time, 30, 40 years, will average about 9 to 10%. So if you're going to invest in an individual company, obviously the goal is to beat that return. So we want to make sure that we're getting at least 15% on our money investing in individual companies, because that makes it worth it. That compensates us for that additional risk. And then you can also say there's a desired margin of safety. So even when you discount the company's future cash flows at a rate of 15%, I still want to buy it for lower than that because my assumptions might be wrong, right? You know, when you're doing these types of assumptions in investing, it's not exactly a science, it's an art, and no one can predict the future. So you're very much just going off of what you think is reasonable, just given what you know about the company and what trends you can see playing out in the future. Now, I put a desired margin of safety of 0, and the reason for that is because this is a rather safe company. And really, if you can get 15% or projected to get 15% return on your money in a company like this, then that's an investment you should be making all day. You shouldn't really be seeking additional margin of safety. Some people may disagree with that and think, no, you should still have additional margin of safety, which I totally understand. But for the sake of this video, I'm going to leave it at 0. So over here is basically what the revenue will be. So we looked at that, and then 3.5% of that goes to free cash flow to equity. Again, it won't be exactly as perfect as this. It fluctuates a lot more just depending on what the company decides to do with using their, or paying down debt or issuing debt or investing in new capital expenditures. Their shares decrease every year because they're buying back shares. We're going to assume they continue to do that. And this is our free cash flow to equity per share. So this is what we get for investing in them. So this is kind of like the stream of cash flows on a per share basis, and it gives us an IRR of 7%. So that's not that good. We want one that's a bit higher than that. And then if we look at the DCF model here, basically the same thing. The math works a little bit differently, but it's essentially telling you the same thing. we get an intrinsic value per share of 27.06 in USD. So let's quickly put that into Canadian to see what it would be. Assume the same exchange rate, so $33. So I believe now this company is valued at around $48 per share in Canadian as of I'm making this video. So it's a little bit higher than that. And based on these assumptions, you won't be getting 15% annual return. Again, you might actually end up getting 15% annual return if the business does a lot better than the assumptions here would suggest. But using this, what I like to think is a rational approach to valuing companies and projecting future returns, it does seem unlikely. And I think that makes sense because this is a company that a lot of people look at. Like we saw, it's the 16th largest company on the TSX. And if it got to a point where, if just using very basic assumptions, very mid-level assumptions, you could get a 15% annual return on this company, then that would present a really strong buying opportunity, and the shares would probably just go up, and before you know it, they'd be valued too much and the buying opportunity is gone. That's just kind of how it works for companies that get a lot more attention. Now, this company doesn't get a lot of attention in the media because it's a little bit more boring of a company. It's not an up and coming tech stock or Shopify or one of the FANG stocks or anything like that. But it is a large company, and it is generally seen as more of a safe company because it does have such a strong track record of good financial results. But let's play around with the assumptions a bit. Let's put their revenue growth to 10%. So this would mean in 2028, they're doing almost 90 billion in revenue. Our IRR goes to 10%. So that's a lot better. That would make the investment a lot more attractive. And if we could change our assumptions a bit more, like say if they get to 10% annual revenue growth rate, maybe they're having 4% of that's converted into free cash flow, then the IRR goes up. So you can see what happens when you change your assumptions. And we could even make it better if we go say they buy back 1% of their shares. So that has a very small effect, but it does have an effect overall. So you can see based on your assumptions, you can test your assumptions and figure out what is the rate of return and how does it change. Okay, so now let's just go over my final thoughts on this company. So I do have to say that I'm a little bit torn because the company clearly, as we saw, has a very good track record of pretty strong financial results, right? And I wouldn't say they're a dying company necessarily because really with the exception of the last 2 years, their revenue has grown rather consistently year over year. But based on what we saw, and where their share price is at now, it has actually surged a bit recently in the last little bit. And based on the returns we projected in the financial model using that current share price, it doesn't seem that buying into them at their current valuation is really worth the risk. It does make sense to assume that they will recover from a very poor 2021 year because of the lockdowns, obviously, but I'm just not sure that I can say with confidence that I know what a business like this will look like 10 to 20 years down the line. And especially if that EV charging station project that they're doing proves to be enough to actually replace the potential decline that we may see in their gasoline or their gas station revenues. Now, maybe some of you guys disagree with me on that. I'd love to hear your thoughts. So drop a comment down below. If you have an opinion on this company you'd like to share, I'd love to hear it. But anyways, guys, that pretty much does it for me for this video. So thank you for listening. I hope you learned something from it. And if you did enjoy it, then please leave it a like and subscribe if you're new to the channel. And with that in mind, I'll see you in the next video.